Good morning, Wall Street. In this video, we're going to follow up on our last video about options ranks and options indicators. In this video, we're going to look at exchange-traded funds, ETFs, and their option indicators to see if we can't get a measure of sentiment from that data. We're looking at the Biotechnology Holders ETF, the BBH. We're going to turn our crosshairs on here. We're looking at our Erlanger option rank. What this does is it combines the information from the put-call ratios and the call-put ratios into one number. And when that ratio is low, that means the call activity is dominant over the put activity. And when the ratio is high, that means the put activity is dominant over the call activity. So we extrapolate from that when this ratio is high, there's an extreme amount of bearishness on the part of options traders. And when it's low, there's too much optimism. We often use the DMA, the displaced moving average channel, as a trigger to a setup. And what we see below here is the DMA oscillator, which just simply tells you whether the price is above the DMA channel, in which case we have green. If it's inside the channel, it's yellow, and if it's below, it's red. What we get from the DMA oscillator is a more easy way to represent the price action as time goes on. It makes it easy to compare what's going on with the options rank and the price action. And we can see here that we have several periods of heavy put activity relative to call activity. And as soon as you get into this upper echelon in the options rank, you have the market tend to move up against those negative bettors. So all this put action in here is being squeezed out by the market action here, while it's mostly green, until finally at this point the puts capitulate, and you now have a period where the call activity is dominant. And you can see by the red in the DMA oscillator that price action is weakening into this optimism, until the optimism swings back over to one of pessimism. So now we have, again, put activity dominant over call activity, but prices are rising. We have the green in the DMA oscillator. The price of the BBH is moving above its DMA channel, putting the squeeze pressure on these negative bettors. But here's an interesting thing. We have a little bit of red here as the market pulled back. The options rank didn't fall all the way back down, which means that we never got too much optimism from this swing up. Just a little bit of a pullback in price got us back to an excess level of put activity over call activity, and price strengthened from there. So this was a very key moment where we can say that the market is perpetuating bearishness in the face of strong price action, and that's a positive. Now, this is a pretty classic representation of options activity, but you know, things aren't always that simple and always that easy. Sometimes it doesn't work. Sometimes the majority can be right. And so let's take a look at that and see how we might handle that. But we don't have to go back too far, where we can see this fairly steady amount of call activity, which means that there's a lot more enthusiasm about the biotech holders here than negative sentiment. But we can see that price is improving. Price is definitely on the positive side in terms of its DMA channel. So this is not a put squeeze setup. By put squeeze, we mean we don't see a lot of put activity out there that can be squeezed by the price moving up. The calls were right in this situation. And that's pretty powerful information here. Now, eventually you did get some put activity in here, but they capitulated fairly quickly, and that's when price decided to turn around and pull back. So the point here is that a squeeze situation is a two-factor model. There's two things you have to observe, not just sentiment, but also price action, which is why we have these two indicators here. And the opportunity arises when you're seeing similar colors here. That's what you want to see. You want to see red and red, red and red, green and green, green and green. So let's take a look at the Diamonds Trust, which is an ETF on the market, in this case the Dow Industrials ETF. We see a fair amount of call activity here as price moved up. The call action became clearly dominant over the put action. The price turned around. You have the red on the DMA channel, so you have red on red, and price receded back. And in fact, even though price recovered here, it wasn't until here that you saw a lot of put activity relative to call activity. So here's your signal right here. Wasn't much of a move up in this market. We'll take anything. As price progressed, you could see that the put activity turned into call activity, and price action started to weaken again. Now we seem to be stuck in this rut of call activity here. You're getting some choppy action in the market, but this is a little bit of concern. This is as of last night's close. Let's go back in time a little bit farther and see if we can't see some other really good signals. And one of the things I want to point out to you is that taking a look at the larger picture can be of value too. Now, options trading is very short-term oriented. Most of the volume in options trading is involved in options contracts that don't have a lifespan larger than 2 or 3 months. But by observing the ebb and flow of sentiment as expressed by the options, you can glean some information. So let's do that here. Take a very large picture and let's go back in time. Let's go way back in time. And we're back to 2005, 2004. You can see that there's a lot more green here in the options rank, which is to say that as things go back and forth, you have a lot of pessimism that builds a base for the market to move forward. And even as it starts to progress higher, you get these bouts of put activity and not very much dominance on the call side. That's extraordinary considering how far up the market moved here. And even in this great stretch between 2006 and 2007, you have this persistence in fighting it all the way up until you get to here. And we're starting 2007 with a lot more dominance of the call activity relative to the put activity. So in my opinion, you started to plant the seeds of a poor sentiment picture as far back as late 2006. Now, price kept going, so that's part of the model, but as you can see now, there's hardly any willingness to buy puts in this market. This whole move up in 2007 convinced options traders to eliminate buying a lot of puts as a strategy for going forward. And that could only be seen in a measure like this. The bottom line is that sentiment shifted clearly over to one of excess optimism, pretty much due to the price action in 2007. Price is the ultimate persuader, and at this point, the enthusiasm had obviously hit extremes. You can see that not only in the dominance of the call action, but the willingness to buy puts just diminished to next to nothing here. When there were bouts of put activity, they didn't last long. The most meager of moves up in the market convinced options traders to get back on the long side. And so the market is doing a pretty good job at confounding the majority over the last few years. Hope that helps. See you next time.